Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Monday, May 10, 2010. European policymakers unveiled an unprecedented loan package worth almost $1 trillion, as well as a program of bond purchases, as they spearheaded a global drive to stop a sovereign debt crisis that threatened to shatter confidence in the euro. We came back from the weekend with a new, much larger rescue package hammered out over the weekend by EU finance ministers. Here are the key developments. The 16 Eurozone nations will create a lending facility worth 750 billion euros. 440 billion will come from Eurozone nations, 60 billion more will come in loans from the EU budget, and as much as 250 billion euros may come from the IMF. The ECB will be able to buy government and company debt and will also bring back its unlimited fixed-rate offerings of 3-month loans, as well as reactivate dollar swaps with the Fed. Over the weekend, we had the final votes that finalized the 110 billion euro aid package already on the table for Greece. The amount of the loan facility, close to $1 trillion, should be large enough to stabilize markets and did so today. It is an unprecedented move in that the ECB could begin buying government and corporate bonds in order to add liquidity to these markets. This is something that Trichet said the ECB wouldn't do just last Thursday following the interest rate decision. Also, the ECB will reactivate dollar swaps in an effort to increase liquidity in money markets. The LIBOR rate, or the rate at which banks charge each other for 3 months loans, slipped in today's trading following the news. Rising costs in the market for dollar loans between banks began to show distrust in the financial system late last week, which meant that we had systemic risk. The ECB will start to offer unlimited fixed-rate 3-month loans after it took this tool away in its attempts to normalize monetary policy. So overall, this was an overwhelming show of force by the EU, Eurozone nations, and coordination by main central banks. So let's see what was the result. In Europe, stocks rallied the most in more than 17 months. The Stoxx Europe 600 index soared 7.2%, and regional major indexes in Germany rose 5.3%, in the UK we saw an increase of 5.2%, in France 9.7%, and in Spain 14%. Turning to the US, the Dow Jones Index gained 3.9% on the day, with the S&P 500 up 4.4%. Treasury prices fell as yields on the 10-year Treasury note rose to 3.54%. Also, crude for June delivery, the most active contract, rose $1.69 or 2.3% to $76.80 a barrel on the New York Mercantile Exchange, though the contract did hit an intraday high of $78.50. First, let's take a look at the euro-dollar pair. Following the open for Sunday, we did have a pretty large gap higher as we had closed around the 1.2730 level, but then opened around 1.2920. That moved us above our 50-period moving average as well as our 100-period moving average in the 1-hour time frame. In the Asian session and in European trading, we continued to rally as we tested above the 1.3050 level, which also ran up against our 200-period or longer-term moving average. And after that, we did see the euro give up its gains, and we slid all the way back down to 1.2790, which was close to our high that we had seen on Friday's session, but also our 50-period moving average again. Following the rally to start today's global session, we did look like traders wanted to close this gap, and we'll see if we're able to do it during the Asian session. We're pretty close to doing it already. We can draw a Fibonacci retracement of the most recent rally, and we see that today's support came around the 50% level. If we remove this Fibonacci retracement and do one of the sharp slide we saw throughout all of last week, we see that today's resistance came around the 61.8% area. We now have a short-term upward sloping support line setting up if we connect all of our lows, and we look close to reaching that level soon as well. So while we did have a very large rally in equity markets and in commodities, including oil, it seems that the euro is still under pressure, or at least there's some lingering uncertainty remaining in the currency market. So let's take a look at the euro against some of its other major rivals. Taking a look at the euro-yen pair, we also saw a gap higher, which broke us above our short-term downward sloping trend line as well as our 50-period moving average. And here too we rallied up until our longer-term moving average, or our 200-period, around the 122 level. From there, similar to what we saw in the euro-dollar, the euro gave up its earlier gains, and as of the closing of the Monday global session, we're around the 119.40 area. So following this very sharp slide to end last week, we have managed to move back to test this old support level which we had around Monday. If we take a Fibonacci retracement of our full down move during the last week, we see that our resistance here came right at the 78.6 level, as well as our 200 period moving average. So here, similar to the euro-dollar pair, we're seeing a correction to the most recent rally. And as of right now, we are around the 23.6% retracement of this rally. So do we see a further move upward by the euro? Will remain to be seen as we move into the next trading session. On the downside, you should look for the 50 period moving average as the next level of support, which will also coincide with this 38.2% retracement of this rally from Thursday's lows. Here we take a look at the Euro-Swiss franc pair, and before we look at today, we can see how flat the recent trading had been prior to last week. Then we had the Swiss National Bank stop defending the level of the 1.4320 level, and we saw the Swiss franc appreciate very strongly against the euro. But then in today's trading, we actually moved all the way back to test our old support around 1.4320, and that was where we rejected the rally we had started after Thursday's low. And similar to our other euro pairs, the euro did give up its earlier gains in the later half of today's trading session. Here too, similar to some of the other pairs we saw, we tested our high from Friday's session, and that was our support in today's trading. In our final cross, euro cross for today, we're looking at the euro pound, and here, unlike in some of the other pairs we have seen, we were not able to move beyond our Friday high. We actually found resistance at 0.8750, and we fell in favor of the pound until we reached the 0.8550 level. There's pretty strong volatility in this pair as we still have uncertainty regarding the UK government situation, though it seems that we are coming closer to a working coalition being formed between the Conservatives, who want the most amount of votes, as well as the Liberal Democrats. Taking a look at the pound dollar chart, we see pretty similar behavior to what we saw in the euro dollar, in that we rallied throughout most of the Asian and European session, but then paired those gains in New York trading. We moved above this 50 period moving average, but then now we're using it as a support level. If we draw a Fibonacci retracement from our low on Friday to our high today, we see that today's support also comes at the 38.2% retracement. Taking a look at the dollar yen, it's surprising, but we had a relatively quiet activity in the New York session after we rallied slightly higher to the 93.30 area. This despite U.S. stocks opening higher by as much as 400 points, at least the Dow Jones Index, and U.S. equities were strong, but regardless, we had pretty sideways action contained within a relatively small pip range. Turning to one of our commodity pairs, the US dollar Canadian dollar, I had mentioned the rise in oil prices, and that helped the pair to move in favor of the Canadian dollar, as well as the risk appetite we had seen in equity markets. So we had closed around this 50 period moving average, but then in our open we gapped below that level down to the 100 period moving average. We broke below that, and we finally found some support at our longer term 200 period moving average, and we ended the day trading around 1.0235. So that undoes all the gains in the pair that we had seen in the volatile Thursday and Friday sessions, and a big bout of risk aversion, but now we're back to trading where we were prior to those developments. We can see that we now come close to testing this old level of resistance around 1.02 that we had broke in the early part of last week, and we'll see if it holds as support, but if we are able to break it, we could move back down to test the 1.0050 area or even parity. So that will do it for today's market highlights. Let's take a look at what to expect in the upcoming trading session in regards to fundamental releases. Tonight at 7 p.m. the UK will post two releases, the BRC Retail Sales Monitor as well as the RICS House Price Balance. Tonight at 10 p.m. China posts a slew of releases, including its consumer and producer prices, industrial production, as well as retail sales. Overnight, we get data from the UK on manufacturing and industrial production, as well as the Australian annual budget. Tomorrow will be a relatively light day for fundamentals from the US, as we get only the IBT TIPP Economic Optimism Index, as well as measure of wholesale inventories. And that will conclude our broadcast for today. For more news, videos, and analysis, please visit cmsfx.com. I want to thank you for watching and wish you good trading this week.